Good afternoon, everyone. It's 1 o'clock. I can see participants starting to join. I might give it another moment to let people come in, and then we'll get the webinar started momentarily. All right, let me go ahead and kick this off. So welcome to our College Savings webinar. September is College Savings Month, and we're excited to be doing our part to help families start saving and meet their goals. Today's webinar features Mark Kantrowitz, publisher and VP of Research for SavingForCollege.com. He'll be walking you through the basics of how to save for college and how to get the most out of a 529 plan. I'm Martha Kordiak-Mert, COO of SavingForCollege.com, and I'll be serving as the moderator today. Now, a couple of notes. We'll be recording the webinar today, and we'll share a link to the recording in a follow-up email. In that same email, we'll include a link to download today's presentation and a super short survey to hear what you thought of today's webinar. We really appreciate your feedback, so please take a moment to respond to that. Also, thanks to everyone who submitted questions. We collected those questions during the registration process. We hope today's presentation will address some or most of those questions. You can also type your questions into the Q&A box here on the screen. We will save about 10 to 15 minutes at the end of the webinar to address questions that you've typed in. We get a lot of questions during these webinars. So if we don't get to yours, please visit our forum at forum.savingforcollege.com, and you can try asking your question there. Also, our follow-up email will contain a link to download our Family Guide to College Savings free of charge. So you can find a lot of answers to your questions in that ebook as well. All right, today's webinar is brought to you by Ohio's 529 plan, College Advantage, the plan that can. I want to let everyone know that College Advantage is currently giving away $30,000 with 3 of Ohio's professional sports teams. I'll be sharing more information on how you can enter at the end of the webinar, so stay tuned. And now I'm excited to announce that Tim Gorel, Executive Director, the Ohio Tuition Trust Authority of College Advantage, is also here today. And he'll be answering a couple questions for us before we get into the presentation. Welcome, Tim.
Hi, Martha. Good afternoon. Good morning, everyone.
All right. Yes, you're right. It is still morning for lots of people who are on this. All right, so before we get into our discussion, Tim, I wanted to kick off with a poll question for the audience. And the question is, do you already have a 529 plan? So I'm putting that up right now. Please go ahead and answer. And once we have, I see the answers coming in, I'll display the results up here once it looks like it's slowing down on the responses. All right, I'm gonna go ahead and end the poll and share the results here. This is pretty split. We actually have a little bit over 50% of people who already have a 529 plan, but close to half that haven't started yet. So, I mean, to me, it's all good news, right? Because it's like either you started saving and you're trying to learn more and make sure you're doing the right thing, or you haven't started, but you want to get the information to start, and that's why you're here today. So that's fantastic. So Tim, let's talk about a couple of things. Let's start with, for the folks who have already started saving. Can you address a little bit on, you know, we're in this very uncertain time. Obviously, I haven't even mentioned how 2020 has just obviously been a very challenging year for most people. Markets have been up and down, the economy is uncertain. So for the people who already have started saving, what should they be thinking about or doing to maintain their goals when the market is volatile and the future is uncertain?
Well, for those who have started saving and investing for those after high school expenses, congratulations. And I encourage you to keep doing that. For those who haven't started yet, I encourage you to start. One of our partners likes to say, when was the best time to plant a tree? Well, that was 20 years ago. When's the next best time? Today. And so if you didn't start already, or you finally find that your beneficiary is going to kindergarten or middle school, don't be in dismay. It's not too late. Continue to save or to start. As far as looking at this environment today, the COVID-19 environment that we find ourselves in, I encourage people to continue those savings. Look at the plan that you're investing in. Is it an all-weather portfolio per se? Sometimes funds are directed towards a certain area, and then in times like these uncertain or volatile times that you referenced, Martha, they really take a hit in the market. Whereas a more diverse plan and more distribution of the investment strategies, will find that you still will fare well, and your investments will continue to grow in this environment, and you will be able to stay on course to those goals that you've established.
Yeah, that's great advice, Tim. And for the audience, Mark will be addressing a little bit more on investment options and 529 plans. But I'll just mention how many changes can people make to their investment options in a 529 plan, Tim?
It is. There's 2 per calendar year, and that's a very good thing to keep in mind, because if you are tempted that, hey, maybe you looked at your fund today and it wasn't doing as well as you thought, maybe you should change. You might want to reconsider chasing different options, both not only for the benefit of doing that, but also that you are limited to only 2 changes or rollovers per year.
Yeah, absolutely. All right. Well, Tim, thanks so much. We appreciate your time today and your support for helping us make this webinar possible. So with that, I'm going to turn it over to Mark to begin our presentation, and you'll pop back in at the end when we begin our Q&A to help us answer those questions.
Okay, thank you.
Thanks.
Thank you, Martha. Before I begin, I'd like to emphasize something that Tim said, which is that it's never too late to start saving for college. Even if your child's a high school senior, every dollar you save is a dollar less you're going to have to borrow, and it can also expand choice. So let's talk about the options that you have available to save for college. The 4 main ones are compared in this table, and each type of college savings account provides a different mix of tax and financial aid advantages. So we have the 529 plans and Coverdell education savings accounts, which are designed for college savings. We have a Roth IRA, which is a retirement plan. And then we have taxable accounts in the child's name, like an UGMA or UTMA account. Now, a key difference is the income restrictions. Now, these income restrictions are contribution limits, not distribution limits. Now, the Coverdell Education Savings Account and Roth IRA have income restrictions on your contributions that are not too far apart, while 529 plans and UGMA and UTMA accounts do not. The Coverdell income phase-outs do not change each year. They are set in stone by law. The Roth IRA limits, however, change every year, and they're adjusted by inflation, and these are the up-to-date limits for 2020. Now, aside from gift tax exclusions, 529 plans and UGMA or UTMA accounts do not have annual contribution limits, while Coverdell education savings accounts are limited to $2,000 per year, and Roth IRAs are limited to $6,000 per year, which increases to $7,000 per year if you're age 50 or older. The tax benefits for a 529 plan, they're often called KEE, QHEE, which is Qualified Higher Education Expenses. And it's a pretty broad set of qualified expenses. The main expense that isn't qualified is transportation costs. A Roth IRA allows a tax-free return of contributions, but there are financial aid impacts of these distributions. Custodial 529 plan accounts are reported as a parent asset on a dependent student's FAFSA, reducing the impact on aid eligibility for need-based financial aid as compared with reporting it as an UGMA or UTMA account, as a child asset. Parent assets are assessed on a bracketed scale with a top bracket of 5.64%, whereas UGMA or UTMA accounts, or the student's own assets, are assessed at 20% on the FAFSA and 25% on the CSS profile, which is used by less than 200 colleges for awarding their own financial aid funds. Now, a Roth IRA as a qualified retirement plan account is not reported as an asset on the FAFSA, but distributions count as income on a subsequent year's FAFSA. Even a tax-free return of contributions is reported as income. It's reported as untaxed income, which functions the same as adjusted gross income. It's part of total income. Now, this can reduce aid eligibility by as much as half of that distribution amount. As I said before, the UGMA and UPMA accounts are student assets. They reduce aid eligibility by 20% of the asset value on the FAFSA and 25% on the CSS profile. It's a flat assessment rate. So $10,000 in a 529 plan can reduce aid eligibility by up to $564. That compares with $5,000 of a tax-free return of contributions from a Roth IRA and $2,000 in an UGMA or UPMA account. Now let's dig a little bit deeper into the college savings options. These savings vehicles differ according to the set of qualified expenses for college and also for elementary and secondary school. The earnings portion of a non-qualified distribution from a 529 plan is subject to ordinary income taxes and a 10% tax penalty, plus possible recapture of state income tax breaks that are attributable to the distribution. Now you might ask, whose tax rate? Well, if the distribution was made to the student, it's in the student's tax rate. If it was made to the parent, it's in the parent's tax rate. And if it was paid directly to the college, it's at the student's tax rate. So let's turn to some 529 plan basics. Like, what is a 529 plan? A 529 plan offers the best mix of tax and financial aid advantages for families who are saving for college. Most of them are state-based, and all but one state offer at least one 529 plan. So now the 529 plans offer a lot of benefits, not just the tax benefits. Well, let's start with the tax benefits. The earnings accumulate on a tax-deferred basis and are entirely tax-free when used to pay for qualified higher education expenses. 529 plans also offer estate planning benefits, such as superfunding, where you can average 5 years worth of contributions that you make as a lump sum as though they occurred over a 5-year period. So that you're not necessarily limited to that $15,000 annual gift tax exclusion. You can do 5 times as much as a lump sum. You just can't do further contributions during that 5-year period. In addition, while 529 plans are in some ways similar to a Roth IRA in that you're contributing after-tax dollars and they accumulate on a tax-deferred basis and are entirely tax-free if used for qualified expenses, the 529 plans offer an additional benefit, which is that more than 2/3 of the states offer a state income tax deduction or tax credit on the contributions to the state's 529 plan. Actually, in 7 states, the state income tax break is for contributions to any state's 529 plan. So that makes 529 plans better than a Roth IRA if you're saving for college. There are no income or age restrictions on contributions or distributions from a 529 plan, unlike other college savings accounts like a Coverdell Education Savings Account. If a 529 plan account is owned by the student or a dependent student's parent, the impact on financial aid eligibility is minimal. 529 plans have no annual contribution limits other than the annual gift tax exclusion, and 529 plans have very high cumulative aggregate contribution limits that range from $235,000 to $529,000 depending on the state. So this chart illustrates that your greatest asset is time. The sooner you start saving, the more time there'll be for your earnings to compound. If you start saving at birth, about 1/3 of your college savings goal will come from the earnings. If you wait until the child enters high school to start saving, less than 10% of the goal will come from the earnings, and you'll have to save 6 times as much to reach the same college savings goal. But you're still better off saving than not, because it's cheaper to save than to borrow. And I'll have to admit, I started saving for my own kids' college educations before they were born. So once you've decided that a 529 plan is right for you, you have to choose a 529 plan. So there are several steps to this process, and we'll go through them one by one. So the first step is, what type of 529 plan do you want to choose? There are two types. One is a prepaid tuition plan, and the other is a college savings plan. The difference is like the difference between a defined benefit plan, like a pension plan, and a defined contribution plan, like a 401k. Prepaid tuition plans let you buy a year's worth of tuition and have it always worth a year's of tuition. And this can provide you with peace of mind. But you usually have to pay a premium on top of the current price of a year's tuition in order to make up for the difference between the earnings and the actual tuition inflation rate. And some of the prepaid tuition plans suffer from actuarial shortfalls. They don't have enough assets to cover all future projected obligations. There are a few that have actuarial surpluses. And frankly, there are only about a dozen prepaid tuition plans left. In addition to prepaid tuition plans offered by states, there's also a prepaid tuition plan offered by private colleges, the Private College 529 plan. Now, 529 college savings plans are much more popular. Investments in a 529 plan can lose money, but investors also benefit from the investment returns. So you have the risk, but you also have the rewards. You can manage that risk by controlling the asset allocation. How much of the investment is in stocks or equities, and how much is in lower risk investments. All 529 college savings plans offer an age-based asset allocation, sometimes called an age-based investment glide path, that starts off with an aggressive mix of investments, 80 to 100% in stocks, when the child is young, and gradually shift to a lower percentage stocks as college approaches. Risk-averse investors can also invest in FDIC insured portfolios within many 529 plans. Direct sold 529 plans are offered directly by the state, while advisor sold 529 plans are sold by financial advisors. So the next step is to look at your state's tax incentives. And you can see here, if we assume $100,000 in taxable income, contributing $100 a month to each of two children's 529 plans, what is the worth of that state income tax break? In Ohio, it's $71. But you should consider not just the state income tax incentive, but also the fees. Sometimes there's a trade-off between lower fees in an out-of-state plan and state income tax breaks in an in-state plan. If you're lucky, you have a state where you have both low fees and a state income tax break. Now let's turn to step 3, which is to research, research, and research. We have many tools on savingforcollege.com for researching 529 plans, including a comparison tool and plan details. You should research the plan manager's track record and the risk that the plan may change managers. Consider also differences in the fees, and the fees can change depending on which individual portfolio you're investing in. Minimizing costs is the key to maximizing net returns. The fees that are shown on this slide are for direct sold 529 plans. The fees for advisor sold 529 plans can be higher, sometimes much higher than the fees for direct sold 529 plans. Some advisor sold 529 plans also charge commissions. So you might have to be invested in an advisor sold 529 plan for 10 years before you make up the difference of that commission. We consider at all of these factors at savingforcollege.com, as well as several other factors, when assigning a 5 cap rating to the 529 plans. Now, once you've chosen a particular type of 529 plan and an advisor sold or direct sold and which state you're going to be in, your next step is to choose investment options within the 529 plan. So that's the 4th step. When choosing a 529 plan, it is Also important to identify your risk tolerance. How much exposure should you have to the stock market? More than 2/3 of families are invested in an age-based investment glide path that manages the risk. It starts off aggressive, but as college approaches, it becomes more and more conservative. There are two main types of 529 plan portfolios, static and dynamic. Static 529 plans have a specific percentage of equities, and that percentage generally doesn't change. An age-based or enrollment date 529 plan is a dynamic 529 plan that changes the asset allocation periodically. It could be every few years, every year, or even multiple times a year. And what these plans do is they try to manage the risk of stock market volatility, which we've seen a lot of this year. Many 529 plans also offer a choice of portfolios with active management and portfolios with passive management, such as index funds. Martha, I believe that you have an additional poll question to ask now.
Yeah, that's right, Mark. Thank you. All right, so let me, sorry, just having a little issue here. Here we go. All right, so our next poll question is a true or false question. True or false, I must open a 529 plan offered by my state. So let me launch that now, and we'll see how familiar the audience is with some of these 529 plan basics. Answers are coming in. All right. All right, so let me go ahead and end the poll. And congratulations, 95% of people got this right. It is false. You do not need to open the 529 plan offered by your state. So pretty savvy audience here. All right.
So now we'll turn to the impact of 529 plans on financial aid. So the FAFSA, the free application for federal student aid, bases the expected family contribution, which is more popularly known by its acronym, the EFC, on the sum of a parent contribution and a student contribution. Each of these is based on contributions from income and contributions from assets. Income includes adjusted gross income as well as untaxed income. That's part of total income, and that's the basis for calculating the expected family contribution. An example of untaxed income is a tax-free distribution from a Roth IRA. Student assets are assessed more heavily than parent assets on the FAFSA. And the student assets will include UGMA or UTMA accounts, mutual funds, and other savings accounts that are in the student's name. The parent contribution is divided by the number of children in college. So increasing the number of children in college from 1 to 2 is almost like dividing the parent income in half. Now, 529 plans receive favorable treatment on the FAFSA. The first $10,000 or so of parent assets will fall under what's called an asset protection allowance and will not be counted. The exact amount of that asset protection allowance will depend on the parent's age, the age of the older parent. Any amount above the allowance is counted at up to a maximum of 5.64% of the 529 plan account value. Other student assets like UGMA and UTMA accounts are counted at 20%. Qualified distributions from a 529 plan are not reported on the FAFSA. Non-qualified distributions, however, are included as part of adjusted gross income. So now let's talk a little bit about when the 529 plan isn't owned by the student or the parent, but by someone else, like a grandparent. So with a grandparent-owned 529 plan, or one that's owned by an aunt, uncle, or if the parents are divorced by the non-custodial parent, assets will not be reported on the FAFSA, but distributions will count as student income on a subsequent year's FAFSA, and it will be counted at up to 50%. Half of that distribution amount will reduce aid eligibility. There are a few workarounds, however. Grandparents can avoid this by waiting until after January 1 of the student's sophomore year in college, assuming that the student's going to graduate within 4 years, to take a distribution to help pay for college. And this is because the FAFSA uses prior year income, 2-year-old income. So if you run that in reverse, that means if the student's graduating in 4 years, income starting the middle of the sophomore year will not affect the expected family contribution on subsequent FAFSA, because it'll be after the student graduates that that FAFSA would be filed. Okay. Another workaround is to give the money to the parents to save in a parent-owned 529 plan account. And there are other workarounds like rolling over a portion of the grandparent-owned 529 plan to a parent-owned 529 plan. It is best if these are in the same state, because several states will treat a outbound rollover to an out-of-state 529 plan as a non-qualified distribution. So let's dig a little bit more into 529 plan distributions. How much should you withdraw? So first thing is that withdrawals must match up with qualified expenses paid during the same year. You don't want to take a distribution in December to pay spring tuition in January, because those are different tax years. It is best to take those distributions after paying for the qualified higher education expenses so that you don't accidentally withdraw too much money. You can withdraw up to the amount of a tax-free scholarship without penalty, but the earnings portion of the distribution will be taxed as ordinary income. Similarly, the American Opportunity Tax Credit, up to $4,000 of tuition and textbooks that justify that tax credit, well, you can avoid the penalty on that amount of a distribution from a 529 plan. With the lifetime learning tax credit, it's $10,000, but that's less common for parents of undergraduate students. Now, if a college issues a refund for expenses that you paid for with a 529 plan distribution, like occurred this spring when they refund room and board because they told students to vacate the dorms in the middle of the academic term, you can recontribute that refund into a 529 plan for the same beneficiary within 60 days. It doesn't have to be the same 529 plan from which you took that distribution. It just has to be a 529 plan for the same beneficiary. And of course, you could always change the beneficiary later. So, and that's a way. Now, if you didn't do it within that 60-day deadline, you could always try to find other qualified higher education expenses to justify that distribution as a qualified distribution. For example, you could, your child is now doing online education instead of in-person education, so you need a computer for your child or better internet access. Those are qualified higher education expenses for a 529 plan. Now let's talk about how to do the withdrawal. You can choose whether to make the payment to the account owner, to the beneficiary, the student, to the college directly, or if the student's living off campus in an apartment, to the landlord. I recommend making that distribution payable to the beneficiary. If there are any non-qualified distributions, they will be taxed at the beneficiary's lower tax rate if that distribution went to the beneficiary. It's also better to keep the money away from the college initially, not make a direct payment to the college, in order to avoid any confusion or complications with the bursar's office or the financial aid office. Some college financial aid offices will not treat it as a payment on account, but as what they call either a resource or cash support, and that can reduce the amount of need-based financial aid which the student is eligible. So now we'll open it up to questions, and back to you, Martha.
Right, thanks, Mark. And thanks so much for the presentation. We've been getting lots of questions, and I'm actually just answering one right now. But let's go through, actually first, before we get into the questions, let me address this enormous, beautiful giveaway that's on this slide that I'm sure is drawing everybody's attention. So, so College Advantage is giving away $10,000 in 3 different giveaways. So it's a total of $30,000. As I said, you'll be getting an email with the link to download this presentation so you can access this information, but you also see the URLs here. So one of these giveaways is with the Cincinnati Bengals. One is with the Cincinnati Reds. And for each of these, it's collegeadvantage.com/Bengals, collegeadvantage.com/Reds 2020. And then with the, those are both open to people across the country. The Cleveland Indians giveaway has some restrictions on your residency and location. And you can find out more about that one at collegeadvantage.com/Indians. So check that out. And as I said, you'll have access to this document with all the URLs. So that's fantastic that Ohio is doing that to help families start saving or keep saving and reach their goals. So with that said, let's turn to the questions. As I said, we've gotten lots of them in. Let's just start with a couple of basics for people who haven't started saving yet. One question that came in was about like opening a 529 plan for a child before they're born and how you do that.
Okay.
Mark, do you want to take that? Yeah.
So there are 2 methods of doing this. One is what I ended up doing, which is I saved in a taxable account, and then once the child was born, I contributed it as a lump sum to a 529 plan. The reason why you can't set up a 529 plan with the child as a beneficiary before the child is born is you need to have a Social Security number or taxpayer identification number in order to open a 529 plan and list that child as a beneficiary. The other method would be to open a 529 plan with yourself as both the account owner and the beneficiary. And then after the child is born and has a Social Security number, you can change the beneficiary to be the child.
Got it, great. And a related question, Tim, you might be able to take this. There was a question about whether there are any tax or other implications. So if a parent does what Mark just described and opens a 529 plan with themselves as a beneficiary and then wants to change the beneficiary to a child, are there any implications people should be aware of?
No, because 529s, as Mark talked in his briefing, the benefit of them is that they're tax advantage. So these are after-tax dollars that are being invested. They grow tax-free. You mentioned about the state benefit, tax benefit. You can still take advantage of that. And as those continue, as I said, continue to grow, they're growing tax-free. And so there shouldn't be any tax consequence to that.
Right. Okay. Great. That's great to know. Another question that came up was about how much to save for college. You know, how should parents be thinking about that? Mark, can you talk about that?
Sure. So first, your college savings goal should be about 1/3 of future college costs, because like any major life cycle expense, you're going to spread it out over time. So at the time the child is in college, about 1/3 will come from past income, savings, 1/3 will come from current income and financial aid, and 1/3 will come from future income or loans. Now, college costs go up by about a factor of 3 over any 17-year period. Since 3 times 1/3 is 1, that suggests that your college savings goal should be the cost of a 4-year college education the year the child was born. And based on current college costs, and you might not be able to predict the specific college that your child is going to enroll in, but you can probably predict the type of college. Is it going to be an in-state public college, an out-of-state public college, or a private nonprofit college? If your child's going to be enrolling at an in-state public college based on national averages, you should save about $250 a month from birth in order to achieve that 1/3 goal. For an out-of-state public college, $450 a month. And for a private nonprofit college, about $550 a month. Now, these may seem like huge amounts, so it's more important to just get started. Set up an automatic investment. You can do so in many states for just $25 a month. Some states you can do payroll deduction for as little as $15 a month, and or $15 per paycheck. And once you get started, you quickly get used to having less money in your bank account, and then you can start increasing the amount you save. Like when your child no longer needs diapers, and that's a pretty big expense, you can shift the money that you were previously spending from diapers to the 529 plan, or daycare to the 529 plan. Or anytime you get a raise or a windfall, a big income tax refund, contribute at least part of that money to the 529 plan, if not all of it.
All right. Tim, I got a couple of questions related to just kind of clarifying who can open a 529 plan for whom?
Good question. Anyway, as Mark said, for as little as $25, you can open a 529 plan. Traditionally, it's parents, and the best time is when that baby is born. And as we talked earlier, that always doesn't happen. Grandparents maybe would get involved. Aunts, uncles can get involved, and they can also take advantage of if a state does offer a tax benefit. For instance, here in Ohio, if you contribute to you're an Ohio resident and contribute to an Ohio 529 plan, regardless of whether you're a parent, grandparent, aunt, uncle, friend, neighbor, you can still take advantage of the tax advantage. We hear so often from parents and grandparents that children have enough stuff. And while that Christmas or birthdays contribution to a 529 plan may not elicit the joy and glee of the latest toy or widget, in the long run, it'll be much appreciated. So anyone can get into the college savings and investments.
That's great advice, Tim. And so basically it sounds like there are two ways that people can help. They can either open a 529 plan themselves, or they can contribute to an existing 529 plan that's open, say, by a parent or something, right?
Yes, yeah, that's what's so great about the flexibility of the plans. Yeah. There are very few limitations in that regard.
Yeah.
When my kids were young,
yes,
they were more interested in the box that the toy came in than the toy itself. After 2 years,
right.
the toy was useless. Better to just give contributions, a gift to college that will benefit them throughout their lives. Or, and if someone's still insists in giving them a tangible gift, sell it on eBay or Craigslist and then contribute the money to the 529 plan.
Yeah, great points. So this is, I guess, a follow-on to that, though, Mark, that maybe you can address is, so Austin had asked about, so if I have leftover money years later, I could change the beneficiary to a niece or nephew. I think Tim has sort of covered that with what he said, but can you, Mark, address a little bit about, what if you end up with money in your 529 plan? I know it probably doesn't happen often, but people always worry about that, right? They worry maybe their kid won't go to college or will get a scholarship. So can you address that, the different options you have for leftover money in a 529 plan?
There are a lot of options for leftover money in the 529 plan. First of all, you don't have to take a distribution. There are no age limits. You could just keep the money in the 529 plan. Maybe the child will want to go to graduate school. You can use 529 plan money to pay for graduate school, not just undergraduate school. Or you could change the beneficiary to be a sibling, or even yourself. Maybe you want to go back to school and get continuing education or get a graduate degree yourself. Or you could leave the money in the 529 plan and leave a legacy for your grandchildren, the students' children, so that just let the money continue to grow and it will help pay for their education. And last, you can take a non-qualified distribution. Now, if the reason you had money left over was because they won a full tuition scholarship, which is really, really rare, or they went to one of the U.S. military academies, you can take a penalty-free distribution. You'll still have to pay income taxes on that distribution and then use it for any other purpose. So there are many options for how you handle having leftover money in the 529 plan. One additional option that came up recently was you can use a qualified distribution to pay up to $10,000 per borrower in federal and private student loans. So you think, well, why would they borrow? Well, there are several reasons why you might have borrowed instead of just using the 529 plan money in the first place. First of all, it might be an older sibling who used up their entire 529 plan, and you have, with a younger sibling, leftover money. Well, you can use that money to help pay down that older sibling's debt. Or you might have decided to use student loans strategically, like maybe you're worried about the stock market this year because it's much more volatile than in previous years, and you just want to give your 529 plan a little bit more time to earn more money to recover from the bear market that occurred earlier this year. Well, you could borrow the money this year and then take a distribution next year or the year after to pay down the student loan debt before too much interest had accrued. And actually on federal student loans, you have 120 days from the date that you borrow the money to pay it off and not have any interest accrue.
Yeah. Hey, Tim, Hina asks, can you still contribute to a 529 plan after the child goes to college?
Yes, that's what we say is today is a good day to contribute to your 529. While you have the benefit of time, if you open the account when a child is born, you have a longer runway, much like with retirement and out years, for your account to grow. But if a beneficiary is in high school or they are in college, you can still contribute. Maybe part of the strategy is like what Mark was saying, to either to build up to pay off some loan debt at the other end, or perhaps that beneficiary decides to change career or go on to get a higher degree in a particular discipline that they're studying.
Yeah.
And you also get the state income tax break for those contributions even when the child's already in college. So you contribute the money, get the state tax break, and then take the distribution and pay the college costs.
Yeah. All right. So I'm just going to go through our list here. We have, so to open a 529 plan, Tim, confirm this for me. You have to be either a U.S. citizen or a legal resident, correct?
Yes.
Okay. Now, Dwight Plan asks, currently, they're here in a U.S. On a visa. They have a 529 account. What happens if they leave the U.S. for a few years? Can they still be the account holder? And will they be allowed to contribute to the 529 during that time?
Yeah, that's a gray area for me. And what I would recommend is talk to a tax advisor about that type of circumstance. Because yes, if you do have the visa, you're here, you can certainly, as this person indicates, contribute to it. What happens if you're no longer here? Again, that would involve a tax advisor, to consult, to counsel the person in that situation.
Great, thank you. Okay, we have a bunch of questions related to the financial aid and withdrawals that came up. So Mark, I'm going to ask you to address some of these. First, just on the definitions, can you go through again what is AOTC and QHEE? That's a question from Ken.
Okay, so AOTC is the American Opportunity Tax Credit. It is a tax credit that you claim on your federal income tax return based on amounts that you paid for tuition and fees, book supplies, and equipment. And it's based on up to $4,000 of those tuition and textbook expenses. And it's a $2,500 tax credit that's partially refundable. So even if you don't have a tax liability, up to $1,000 can be refunded to you. It's based on 100% of the first $2,000 of qualified expenses and 25% of the second $2,000 of qualified expenses. It is available for 4 years, both for academic years and for tax years. It's limited by each. Now, QHEE, or KEY, is Qualified Higher Education Expenses. It is tuition and fees, book supplies and equipment, room and board if you're enrolled at least half-time, special needs expenses that can be, if you use a 529 plan to pay for them, that distribution from the 529 plan will be tax-free.
All right. And Mark, can you run through again the 529 effect on FAFSA being 5.64%? So I think somebody just wanted clarification. Could you just go through that one more time?
So if the money, if a 529 plan is owned by the parent of a dependent student, or is in a custodial 529 plan account where the student is both account owner and beneficiary, it is reported as a parent asset on the FAFSA. Parent assets on the FAFSA are assessed on a bracketed scale with a top bracket of 5.64%. That means that if you have $10,000 in a parent-owned 529 plan or a custodial 529 plan, it will reduce your aid eligibility by at most $564. That leaves you with $9,436 remaining to pay for college costs. And not only will this reduce your debt, but it also gives you the flexibility to send your child to a more expensive college than you otherwise could afford, given that you have this resource available to you.
Okay. Tim, Rosalba asks, how soon can we apply for the College Advantage scholarships? My daughter is only in 9th grade. My guess is it's okay, right?
You're referencing the giveaways. Yes. If you're already investing in Ohio's 529 plan, this is great money to add to that those savings and investments. If you're new to Ohio's 529 plan, what great way to kick off your savings and investments with College Savings Award from Ohio's 529 and one of our professional team partners.
Great. So basically, it doesn't matter what age your kid is. If you want to start saving or you're already saving, find out more about the giveaways and apply. Okay. So Mark, this is a question I think both you and Tim could address, but let's start with you. Alejandra asks, I have 4 kids. Can I save taxes each year on each account, or is there a max number regardless of the number of kids? My guess is this will vary by state. Maybe you could give a general answer and Tim can talk about that for Ohio specifically.
It varies depending on the state. Some states have the state income tax break on a per taxpayer basis, so the number of children doesn't matter. Other states, it's on a per beneficiary basis. So if you have 4 children, you get up to 4 tax breaks based on contributions to each child's 529 plan.
Great. Tim, do you know how that works in the state of Ohio?
Right. It's per beneficiary, and it's up to $4,000 per beneficiary in Ohio. And that's you can take up to that amount off your Ohio taxable income. If you go over that amount, there's unlimited carryover for that. And so going back, to the who can contribute. So say maybe an aunt and uncle are contributing to 2 or 3 of their nieces or nephews' account. Well, they can take that money towards that $4,000 off. So it's contributions per beneficiary, up to $4,000 in Ohio.
Okay. All right. Great. Let's see here. Okay, Deborah asks, what about gift tax on beneficiary change from parent to child? Again, I think that's, I don't think that's viewed, but I don't know, Mark, let me let you address that.
So if you change the beneficiary from the parent to the child, it's not going to be a taxable gift because it's a completed gift already. I know there is some concern about generation skipping taxes, but generally that's not going to apply. And even if you had the gift taxes, and you have over $11 million in annual lifetime gift tax exclusion, so most people aren't going to reach that. And if you are at that level, well, then you have tax accountants and tax attorneys who can tell you what you can and can't do and how to structure things properly. But for most families, you don't have to worry about that.
Okay. This is a great question. Someone asked about changing states after initial selections. I think what they're asking is, I open up a plan in Florida, let's say, because I live here in Florida today, but maybe I move to a different state, maybe one that has a tax benefit in the future. Can I roll over or change my plan? Tim, can you address that?
Yes, the short of the answer is that, and that's a good scenario that you give, because Florida does not have an income tax. So someone moving to Ohio, say, they may want to look at that, being mindful of what Mark advised about, looking at fees and what that overall benefit is. We made reference to what's an all-weather portfolio. Well, you can look at on our webpage, certainly look on savingforcollege.com, for the cap ratings. And, I would recommend doing your homework and seeing if switching the plan over. But as we talked earlier, the beauty of the 529s, you don't have to be a resident of that state, nor are you limited of using your 529 in the state that you're living. You can take it nationwide.
Yeah.
So you have the option of just leaving the money in the current 529 plan and directing new contributions to the new 529 plan. If you want to roll over the money from that original 529 plan to your new 529 plan, first thing you need to check is whether your original state will treat that as a non-qualified distribution, in which case maybe you leave the money in there. Also, the other thing you should check is whether your new state allows a rollover contribution to qualify for its state income tax break. Some states, like I'm in Illinois, they allow that, but just the principal portion of that rollover. I'm not sure whether Ohio does that.
Okay, thanks. And I think I would say for people who are considering that, they should probably check with their current 529 plans. Might be a good place to start to get information about what the rules might be there, right? Okay, I wanted to pick up on something Tim mentioned, which is our 5 cap rating. So I do think that's a great tool for people to get a sense of how different plans compare. So on savingforcollege.com, under 529 plans, you can find our 5 cap ratings. It's an overall rating that we do for every 529 plan, from 1 to 5 caps, and just kind of an overall rating, looking at different criteria like the plan's performance history and the fees that they charge, reliability, and some other factors. It's a big analysis that Mark undertakes every quarter. So, and I want to mention, since it came up, that Ohio's College Advantage is one of the few plans that gets our 5 cap rating for out-of-state residents. So congratulations. Okay, so let me see. We got so many questions here. Mark, how does the distribution from a younger sibling's account for high school affect FAFSA? So I think as they're saying, like if they're using it for their K through 12, that's from Melanie. Do you understand the question there?
Yeah, so 529 plans can be used to pay for up to $10,000 a year in elementary and secondary school tuition. That was added a few years ago. And the distribution is not going to affect a sibling's FAFSA because it's not going to be reported as income. The money in a sibling's 529 plan may potentially be reported as a parent asset on your FAFSA. Because remember, if it's a parent-owned 529 plan, it's reported as a parent asset regardless of who the beneficiary is. And the only exception would be a custodial 529 plan account. That will be reported as a parent asset on the beneficiary of that custodial account's FAFSA, but not on the FAFSA of a sibling. Because it's only the student and the parent's assets that get reported as a parent asset if there are 529 plans. So it can get a little tricky, but generally you don't have to worry about distributions from a sibling's 529 plan for K to 12.
Okay. Tim, this is a question I don't think we covered, but Bhagat asks, they own a New York 529 plan, beneficiary lives in New Jersey, would there be any issue for withdrawing money for college education? In other words, can the child attend college in any state, regardless of where the 529 is?
Yeah, so we make reference to college here, but that's any trade school, technical school, 2-year, 4-year, in-state, out-of-state, public, private. Any entity that has a federal code, by the Department of Education, you can use your 529. So absolutely, in that scenario, the beneficiaries going to school, and provided that there are qualified expenses, that withdrawal can be made from the New York plan to pay for those qualified expenses in New Jersey.
That's a great point, Tim. And Mark, can people also use 529 funds for foreign institutions?
Yes, there are about 400 foreign colleges that have a federal school code, also known as a Title IV institution code. They have that code, as Tim said. You can use a 529 plan money to pay for it. Now, one thing to watch out for is qualified distributions for a 529 plan do not include transportation costs. So the cost of your child traveling to that college in another country, well, that you would have to pay for using something other than a 529 plan, because it would be a non-qualified distribution from the 529 plan. But there are a lot of great international schools that you can use your 529 plan money to pay for.
All right. Someone asks, can you contribute to a 529 at any time during the year? I get bonuses quarterly and would like to contribute the bonus money to the 529 plan on a quarterly basis. Tim, does that work at College Advantage, for example?
Yes, it does. Again, there's just many ways to go about your savings and investment goals. Some, as Mark mentioned, do payroll deduction. Our plan accepts that. Many plans do. You can just out of sight, out of mind, once a month that's going in. Or there may be those periods, as this viewer has asked, and like Mark talked about, different events that come up in people's lives. And so maybe it is a quarterly contribution. Maybe it's an annual one when you get your income tax return. Again, great flexibility, and however you go about contributing that is, is a personal savings preference.
Yeah, you can contribute to a 529 college savings plan at any time during the year, multiple times during the year. With a prepaid tuition plan, you may have restrictions on when you can make those contributions.
Okay, good to know. I don't think we covered this one. It's usually a pretty common question, but somebody asked, can I have multiple 529 plans? And I think as part of that, should you have multiple 529 plans if, for example, you have more than one child? Mark, you want to start that off?
So Joe Hurley, the founder of savingforcollege.com, famously had more than 30 529 plans. So you can have 529 plans in every state if you wanted them. Well, there's one state that doesn't have a 529 plan, and there's a handful of states where you have to be a state resident. But other than that, you could have 529 plans in multiple states. And so there's no real restriction. Now, there are a couple of situations where you'd want to have multiple 529 plans. First of all, it's generally a good idea to have one 529 plan per child, as opposed to a single 529 plan for multiple children, because that lets you tailor the investment strategy to the child's year in school or their age. Because if you have a child in elementary school and another child in high school, your risk tolerance should be different because one is closer to college. If you want to have a 529 plan that you're using for elementary and secondary school, and then also have money for college, then it's probably best to have separate 529 plans for each. And then you can have them in the same state, just different ones for that same beneficiary. And then finally, another reason to have one 529 plan per child is if the state allows a state income tax break per child and per beneficiary, then having a separate 529 plan for each child will mean that you can have a greater tax credit or tax deduction on your state income taxes than if you had just one 529 plan for all your children.
Tim, can you move money from one 529 account to another? Say, if I have two College Advantage accounts for different children, or if I have, one College Advantage account and one offered by another state, can I transfer money between those?
Yes, but just again, you consult with the plan that you're with, and as far as doing that, Mark, you can add to that.
Yeah.
Basically, yeah. So it's because there could be different restrictions, I guess, based on like if you're going out of state, for example, as Mark mentioned, there could be recapture provisions or things like that, right? Mm-hmm. Okay. So consult with your plan on that. Also, Mark, can you move money from a Coverdell to a 529 plan? Can you roll over from one to the other?
You can roll over from a Coverdell to a 529 plan, but you cannot roll over from a 529 plan to a Coverdell. You can roll over from a 529 plan to an ABLE account, but not vice versa.
Okay. It's 2 o'clock. I'm going to sneak one last question in. Is there any limit on contribution limits on 529 plans per year, Tim?
Yes, it depends from plan to plan. Again, like ours, and it's calculated, it's an annual calculation. And for instance, with our plan, it's like $468,000. So you have everywhere from the $25 up to that amount. And again, that varies from plan to plan, and it can change year to year.
Okay, so pretty high contribution limits. Anything to add there, Mark?
Well, and you could have money in multiple states, and the money in each state would be subject to that state's limit, mm-hmm. and not necessarily take into account the money in other states. I don't know of anyone who's tried to take advantage of that, and whether it would ultimately be seen as not kosher by some of the states, because the intention of the 529 plan is to cover up to the cost of the education of a college in the state, and it usually assumes that about 7 years worth of expenses, so undergraduate plus graduate school. So if you have money up to the limit, at the limit for multiple states, well, that's probably a little bit problematic. Now, once you hit a state's contribution limit, the aggregate contribution limit, you can't make any further contributions until distributions reduce it below that limit, but it can continue earning money indefinitely. So contribute up to the limit, and then it just keeps on growing until you use it.
Okay. All right. Fantastic. All right. We are over time. So we'll have to stop there. I'll just remind our audience, first of all, thank you for all the great questions. And I'll remind you, if we didn't get to your question, visit forum.savingforcollege.com. Try asking your question there. Mark will be checking, and we'll try to answer questions, to help you out there. I want to thank Tim Gorell and Ohio's College Advantage Plan for sponsoring today's, and I want to thank Mark Kantrowitz for providing all the great information. So thanks, everyone.
Thank you.
Thank you.